Hey traders, this is Blake Morrow with Traders Summit. And with me for the very first time, I have Benn Maldonado. And, he's a private investor, but, you've done some interviews in the past and it's really good to see you, Ben.
It's great to see you, Blake. Thanks for having me.
It is nice to have you. And I've heard interviews with you in the past with Dale Pinkert from Forex Analytics. And I found your work so fascinating. And I really wanted to introduce it to the Traders Summit community. But before we get into the work that you do, talk a little bit about yourself and how you came to where you're at now.
Well, it's interesting that, because every time you do an interview like this, you have to reflect on, how did you get here?
Right.
Wow. You step back and say, my God, how did I get here? It's a great question. Because it's, life has all kinds of twists and turns. Well, all my life I've been interested in predictions. And, when you're a kid, you think, oh, if someone can predict something, they're really smart. Like they have some magical powers. And as you get older, you realize it's all about probabilities and it's about, what's likely to happen versus less likely to happen. But so I've always been interested in that sort of aspect. And that's what drew me to cycles. My educational background is I got my college degree at Wharton at the University of Pennsylvania, and they don't teach you anything about cycles there. They teach you about, discounted cash flows and net present values and statistics and economics and all that great stuff that you need to know. But nobody's telling you how do these guys time the markets? We had all these great speakers that would come back to school and, Michael Milken and Donald Trump and, Saul Steinberg, who was a big rater in the 80s, he would come back and it's like, how do these guys know when to buy this stuff? And so that's been a quest of mine all my life, is to figure that out. And what I realize is you'll never figure it out, but you can constantly learn more about it. So that's kind of what has driven my journey to get into this sort of heavy cycle work and trading, is to understand when these big turning points are there, are they predictable and can you get an edge? And I do believe the answer is yes.
Well, it's funny. We all fantasize about that too. Like if I could have just known the lottery numbers, or if I could have just seen the GFC coming. But I believe in the work that you've been doing. And like I said, this is not my first experience with you. I've heard multiple interviews over the last couple of years when you meet with Dale Pinkert, and I've found your accuracy of what you do to be, pretty good. And so that's why I think it's really interesting to have this opportunity to speak with you. Now, you say you do manage your own money, you trade your own money. Yep. And how did you get to that point where you started just managing your own funds?
Well, I started off out of college working for Merrill Lynch.
Okay.
And I worked for them for 13 years on the retail side. And I did a little bit on, working with the institutions and, funding corporations and helping, bring companies public. And then, 22 years ago, I just decided that it was time for me to move on. And I started managing my money then. And I have been doing that ever since. In addition to other, sort of entrepreneurial ventures in real estate, and did a little VC stuff and just kind of seeing different aspects of finance and running businesses. And this one has always been a constant, right? It's always been there, even though I sort of drift away sometimes and chase the hot thing that's going on. But and that's sort of what led me to this place of running my own money and really trying to figure out, quote unquote, how things move in the markets.
Well, I'm excited for everybody to learn about some of the work that you've done. So let's get to it. You brought a bit of a presentation, and I have to say, Ben, we're in obviously a very unique period in time. And would you say this, and you can go ahead and share your screen and we'll just kind of talk it through. But would you say we're in a unique time because we're in a situation where the markets have been in this, basically minus the COVID lockdown, we've been in this expansionary period for quite some time. So how do you forecast that, or forecast the future, if you will, or try to fit cycles in when you had this pandemic of that really was a black swan event, in retrospect, a couple of years ago? So has that like shifted how you view things now?
Well, I think, Blake, your observation is astute because the big cycles that we're experiencing now, nobody that is alive on Earth has ever experienced what we're going through.
Yeah.
And it is why I believe most people feel so confused and uncertain and sort of on edge about all this stuff that's happening because there's no experience, right? The human beings who experience this sort of thing are dead and gone. So
Yeah.
all of us that are alive now are experiencing it for the first time with nothing to fall back on.
Sure.
And so, given that, I think what I'd like to do real quickly today is kind of run through the big cycles that we're experiencing, then a smaller cycle, and then get into sort of what the investment implications, I believe, are of those things that we're experiencing.
That sounds great. All right. So without further ado, go ahead and get started.
Great. So the major cycle that we're experiencing now, I call the Epoch Cycle, is a 400-year cycle. And this cycle has been driving, let me move this, we'll get to here we go. So it's a 400-year cycle. I call it the real Great Reset. And the reason I call it that is everything that we've been used to or accustomed to and built up over the last 400 years is coming to an end. And, I know that sounds sort of Armageddon-ish. It's not really Armageddon-ish. It's coming to an end, meaning it's going to not work anymore and be replaced by something else.
Okay. And do you mind, as you're going through your presentation, if I'm going to interject just a few things here and there. People talk about the Great Reset. A lot of people talk about it from a, currency standpoint, we're going to have a great reset and, all fiat currencies will go to zero and, or be reset and, balance sheets will be restored. And, or some people from a political standpoint might say, we're going to have a civil war. So your great 400-year Great Reset, how are you defining that? And I'm sure you're probably going to get into it.
Well, I think the big thing is, what the Epoch Cycle was about, going back to the 17th century, was about the development of large, centralized institutions that allowed us to organize and govern societies. So it was governments, it was militaries, it was sort of states, it was, cities. Everything was organized under a structure where power was centralized and then went down. What we're seeing is, and what we all experience almost on a daily basis, is a loss of trust and faith and belief in these institutions. Like, they're starting to let us down with crazy speed. I mean, the most recent one I talk about, and I'll go into some examples, but the fragmentation phase that we're going through now is what's really causing a lot of the anxiety in society, because things that we used to depend on are no longer working. And what we're heading towards is a time period where the background weather or the frequency is going to be supportive of decentralization or more individualistic or small communities, as opposed to these larger sort of behemoth type organizations. So let's go through some examples and I'll show you.
Let's do it.
So on this slide, as they happen, I add them. The recent one I've added, I think, is the Supreme Court and the markets because of the LME nickel fiasco, right? Whoever thought you'd see a market where they would just say, you know what, those trades may have been executed, in a good manner and legally and everything, but we're just going to cancel them. They're not going to count. It never happened in my life. Blake, do you ever remember that happening in a market?
Never. Yeah.
And so what that does to people is it's like another blow against this belief or the faith in an institution like a market. And then the LME's been around for almost 200 years, I think. So an institution where we look at it and we say, wow, I can't trust that anymore. I got to reconsider if I'm going to trade there. The Supreme Court leak has undermined the confidence and the belief people have in the Supreme Court now. And then the other ones you can see, they're numerous there. with the fiascos we've had in elections for the last few cycles. Elections and democracy are certainly there.
Yeah.
Supply chains, medicine and scientists with the whole, pandemic thing and how they flip-flopped and changed, and then, information comes out. You mentioned fiat currencies, Blake. I think fiat is right on the board. Are they going to last? Probably not. What's going to replace them? Everybody was thinking crypto and this, crypto is going to be it. I don't know. Maybe. But I don't think the way the currencies are structured are going to be around, 5 to 10 years from now.
So Ben, do you think because we are in this, I always like to use it as or define it as an information age, where information is so readily available globally since, the 90s, since the dawn of the internet. Is that what really pushed us into the edge of the envelope of the 2026, if you will, 400-year epoch cycle?
I think it certainly helped because it has been a way to sort of push power from the center more out onto the periphery. Like the individual has power now because they can access information, they can create information, they can create content, they can start their own news channel. You don't need a national news organization. So I think it's a contributing factor to the sort of the last stages of this epoch cycle.
Interesting. Okay.
Yeah. And I think the big theme to take as an investor is anything that's dependent on centralized control or centralized power is going to struggle going forward, because what was supporting it for the last 400 years is no longer going to be there. And a more dispersed, decentralized, individual type of system is what's going to have sort of the wind at its back and have the best chance of success. So
as you're explaining this, I'm thinking it through, but what would be, in your opinion, Ben, what would come the next 400 years, if you will? Do you have any ideas? I know
the next cycle is going to support the individual.
Okay.
The small community. So more of a tribal thing. You mentioned about a civil war. Maybe it doesn't end up being like one side fighting against the other, but breaking up into smaller pieces, right? Where there are little tribes with similar views, similar values, similar wants in life, that sort of thing. But that's kind of where we're heading. Is we're heading to this dispersed, decentralized, more local, as opposed to national or global organizing structures.
Interesting. Okay.
Yeah. How that's going to play out, we don't know, but we know that that's what it's going to be supportive of.
Okay.
The other main thesis that I've talked about, as you mentioned, with Dale for the last 3 years, and it continues to be a part of the driver of my investment thesis, is the cycles that we're currently experiencing now are directly connected with what went on in the 1970s. And that's why I've been talking about stagflation and commodities and real assets for 3 years, because the connection is there, and that was what was working then. And you look and you say, okay, where are they now? We saw they were at the low of the cycle. They've taken off. And I do believe we're only like in the middle innings, maybe the fifth, sixth inning max in that sort of thesis. So I think we still have another 2 to 3 year run in commodities.
And it was this particular slide that you'd presented a couple of weeks back with Dale Pinker that actually provoked me to approach you for the Trader Summit platform, because I look at the similarities between the 70s and today, and it is pretty staggering, isn't it?
It's shocking, isn't it?
Yeah, it is.
You would think that it couldn't be that close, right? And the cool thing, Dale, is on Twitter, I'm pretty active on Twitter. A lot of my followers, when they get something where there's a reference to the 70s, they'll post it and say, hey, look at this, check out this connection. So people are starting to think of it, and there are a lot of them. I mean, you can look here. This is just one list. I could compare Nixon to Trump, Republican president, personally very unpopular. all kinds of other connections of, what went on under Nixon and what went on under Trump. The other one that's really, really telling now, which we're in the middle of, is the connections between Jimmy Carter and Joe Biden.
Wow.
Stagflation is here. We're dealing with it. The latest one I put, which is even since Dale's thing, the first case of human monkeypox was in 1970 in the Democratic Republic of Congo, and now monkeypox has returned.
That is wild.
I mean, again,
you just added that to the list.
I did. I just added that because I just saw the connection in the last week or so since I spoke with Dale. It is uncanny. If you're now that what I really try to do through these talks is put the awareness in people's minds, and then they can see it. They'll see examples of the Epoch Cycle where we're losing confidence and faith in these institutions that we once depended on and revered. You'll see the connections between now and the 70s, and you'll be able to sort of be an observer of this change, and then it'll help you, I think, and I believe it'll help you in your investments and your trading and how you approach life.
I 100% agree with that. And let's be clear, just so everybody is aware, that was the 70s, and those are parallels to what we see today. But fast forward it, another 50 years to where we are today, and we're still here, right? So there hasn't been Armageddon yet. So, but let's see what else you got there, Ben.
Yeah. So you can see the other connections. The ones I would say to really focus on for your investments right now. In the 70s, the Fed was massively behind the curve. They are massively behind the curve now. And there was a commodity boom in the 70s, and we are experiencing a commodity boom now. And as a subset of that, I believe we are entering, if not already in, the second energy crisis that is unfolding and is going to get a hell of a lot worse than people think possible right now.
Wow. Okay.
So let's go to the next one. These are some of the themes that I laid out for today, for the year 2022 with the talk I gave in Dale at the beginning of the year. I wanted to highlight it, not to say, oh, look how great these are, great predictions. It's the key themes that are going to continue that I want people to be aware of, because that's going to affect how you invest going forward. Number one on my list is the cycle we're experiencing now for the next 2 to 3 years continues to say we are going to suffer from limitations and shortages. So economic growth is going to be limited and shortages are going to be prevalent. The latest one, my kids are older, so it hasn't affected me, but I certainly see it, and I feel for the people who have young kids. This is baby formula shortage.
Yeah.
I don't think that's a one-off. Like, I think we're going from, one item to another, right? And it's just moving, and it's going to continue to be present. And how does this relate investment-wise? If you think about commodities, shortages of commodities mean reduced supply. If you have the same demand or more, it means higher prices. So this is why I believe we have at least 2 to 3 years to run in this commodity bull, as this sort of background weather of limitations and shortages keep, commodities on the bid, so to speak. The other two that have hit already this year are volatility. We've seen tons of volatility. I think it's going to be with us for a while. And we've seen that in an elevated VIX. They can't get the VIX below 25. It's really difficult right now, and it's hanging around 30. So I think volatility is here to stay. Power, might, and violence. I put this slide out before Russia invaded Ukraine. So that is certainly a byproduct of that power, might, and violence theme. And I do think for the next few years, we are in a cycle that is supportive of conflict and war, conflict both within societies and between societies.
Yeah.
So, and that's probably, sort of a nice sort of reflexive feedback loop. You got conflict, you're going to have shortages. You have shortages, you're going to have limitations. You got shortages, you're going to have conflict. It's most wars are over resources. So,
of course. Now, the last one you don't have checked is the myth of eternal growth is shattered. Now, I'm only going to assume, and I'm obviously want you to expand on this, but I'm only going to assume that you mean, look, I'm an investor, and if I just put my money away in the stock market, it's going to internally grow, or I'm going to buy real estate, and my home today, it's going to appreciate by 3% on average every year for the next 20 or 30 years. Is that what you're talking about here?
Partially, as well as what we've experienced for the last 20, 30 odd years is this trend of globalization, right? Where we take factories, we move them to a place where the costs, the input costs, including labor, are much cheaper. And therefore, it looks like companies are growing profits and growing revenues and everything's great. But really, there's no actual numerical growth in their business. It's only, through cost cutting and globalization. Because of the cycle that we're experiencing, and this I call it deglobalization, that's now going to start as people conserve resources and hold on to them. This myth of, we're going to grow every year and the next generation is going to be better than the previous generation, that is going to be completely shattered, and people are going to realize, hey, I can't do what you said, Blake. I can't just put money in the market and forget about it. I can't just buy a house and, it's going to go up every year for 20 years or 30 years. You might not have that anymore. And that's going to be a cause of this re-onshoring of supply lines and people bringing resources and manufacturing back home because they can't depend upon, and again, think of the Epoch Cycle, right? You're not depending on a centralized system. You have to be local. You got to keep things local.
Interesting.
So that's what I believe is coming too. So let's talk about some of the second half themes, because these are important in terms of what we're going to see in the next 6 months. One of the things that I think that's really going to be confusing to investors is this pulsing nature of this cycle. And when I say the pulsing nature, I mean it's going to be both. It's not going to be constant. It's going to be more like a strobe light, right? Off, on, off, on, off, on. So, and I have a couple slides I'll go over regarding inflation. People are going to get fooled into thinking, oh, we're the worst part is over. It's gone. It's going to be getting better, and then it's going to come back. Or growth is going to slow down, and then they're going to say, oh, we're going to crank back up again, and then we're going to slow down again. So those kinds of things are going to be at play. The limitations that I talked about on the theme is going to be causing decreasing economic activity for the remainder of the year and going forward. So we have to be aware of that. And with high inflation and slow growth, you have stagflation. The nationalism, localism, like bringing things back, the reverse globalization, it's starting already. There's a handful of countries, India, Russia, China, and the US, who have all talked about not exporting or reducing exports of certain commodities, whether it's sugar, fertilizer. In the US, it's talking about gas. China has their rare earth minerals. Everybody's going to start hoarding and keeping that stuff for themselves. Food security is one I've been talking about for a couple of years. Unfortunately, I think this one's really going to come to bear in the second half of this year. In the US, I don't think we're going to have people starving. There's going to be problems getting items, and there's going to be a lot of expensive things. You're going to have to lay out a lot of cash for things you want. But in other countries in Africa and Asia and the third world, it's going to be devastating. And that's a real problem. There's a marker for a cycle of a crisis that's coming. I don't know what it is. I don't know exactly when, but in the next 6 months, we're going to all experience some sort of global crisis, which is going to create this sense of hopelessness. So, here I am, doom and gloom, bringing all this to you. But again, I'm not a predictor. I'm simply a messenger of what the frequency that we're going to be experiencing is. I hope things aren't as bad as they potentially seem like they could be.
Sure. When you talk about nationalism and reverse globalism, and I want to just before we talk about your next slide here, that sounds great in theory. buy America, if you will. And I'm just using, since you and I are both in the United States, using that, buy America and, don't buy China or anything else. But you're talking about different countries doing that. What's the issue that we have here in the United States as far as, you take, our workforce, our young workers? I mean, how likely is it to change generations to where they believe that, working in a factory, building our own products is, everybody wants to buy our products, but who's going to build them? And where's that labor force going to come from? You say you have kids. I have kids that are late teens going into young adulthood, and asking them to work in a factory would be not their TikTok star ideas that they have in their head. So what do you say about that, Ben?
It's going to be interesting, because what we're going to have to end up doing is paying higher wages and having higher priced products. But the trade-off is it's going to be a reliable supply.
Yeah.
So as long as we have that, where there's the benefit, like, okay, yes, you're going to work in a factory, but maybe you're going to be producing high-end electronics like semiconductors, right? They're talking about making billions, the government's, billions in subsidies for reshoring semiconductor production. Maybe that's not such a terrible job, right?
Sure.
It's high tech. But we are going to, as a society, we're going to have to accept that trade-off of, we have a secure supply, but it's going to cost us a little bit more, and we're sure of it, right? It's American made, right? You could say the whole quality thing, and that they're going to have to kind of sell that thing. The labor question, I guess it's got to be partially immigration and partially, a part of our society saying, yes, I will do that. The wages are good enough, and I'm going to do that because that's where the jobs are.
All right. Well, that probably will parlay into your next slide here, talking about CPI, because it's all going to factor into higher costs, right?
Yes, absolutely. And if you look in the, I want to give this as an example so people don't get thrown off by feeling like, oh, the worst of inflation is behind us. This is the monthly CPI from 1970 to 1980. And the little boxes I've circled are sort of highs and lows. And the thing to look at is, in 1972, in June of 1972, you could have said, inflation is dead. Look, it's 2.7% after coming down off of 6.2 in January of 70. Well, then by December of 1974, it was 12.3% in December. And then it came back down again to 4.9% in December of 76, only to peak out for the cycle in 1980 at 14.8% in March.
So that's a lot of years of greater than 2% CPI that the Fed targets. Absolutely. Right? Yeah.
And Blake, I in my heart, given the cycle that we have and the economic backdrop, this is what we're looking at. I think it's fantasy to think that inflation's going back to 2% quickly and it'll stay there. And again, in markets, we look at things in probability. So we say it is a low probability event that happens. The much higher probability event is we're going to see volatile, pulsing inflation with higher highs and higher lows. Here's a chart that one of my followers made, and I just thought it was fantastic because it was a good visual of. And I mockingly said that peak is the new transitory. Because you remember everybody and their mother, the talking heads were all saying, oh, inflation is transitory. Don't worry, it's coming back down. Now they're saying, well, we're at peak inflation. Don't worry, it's coming back down. Well, they may be right. We might be at peak for the short term. But I don't believe for this cycle, any way, shape, or form, probabilities favor that we've seen the highest inflation we're going to see yet. And this chart, I think, is a representation of how inflation performed over the last few cycles going back.
And looking at your chart, I mean, this is not a monthly chart, by the way. You're actually looking at like many years into the future.
Absolutely.
Yeah. Okay. Just to make sure everybody's clear as they're looking at, they're squinting and saying, wait, are those decades? Are those, is that a decade? It is.
Yes.
So
Yeah, it's a long time.
it is.
Here's this slide I put in just to show the pulsing nature and the limitation of growth they saw in the 70s. The inflation and disposable income and employment. We had multiple recessions in the 70s. We had a recession. We came out of it for a couple of years. We had another recession. Came out of it for 2-3 years. Had another recession. I wouldn't be surprised if we don't see something similar in the decade we're in now. This is our reverse globalization chart. We've already seen a peak in globalization, based upon this metric, which is value as global exported goods as a share of GDP, and it's already rolling over. The key thing for me about this is that the cycle and the background weather and the frequency is supporting not globalization, right? Reverse globalization. On the way up for 400 years, we've been supporting that. That's over. It's coming to an end in 2026. So you got to feel like we're at the peak and it's going to change, and understand what are the investment ramifications of that.
And it's interesting you say that at the very end. I know you're forwarding. I can't wait to actually hear what some of your ideas are about where we should be putting our money. But continue.
Absolutely. On. Absolutely. So unfortunately, hunger equals riots and violence. And it kind of all feeds into the themes. Food prices are high. They're going higher. It is a major, major global problem.
And I'm assuming the global warming, or let's not say global warming, maybe the shift in global, well, call it whatever you want to call it, that's going to probably put a lot of pressure on those food prices and commodity costs moving forward.
Absolutely.
Yeah,
absolutely. One of the big themes I think we all have to look at and have exposure to in our portfolio is energy. I believe we are in the midst of the second energy crisis, the first one being in the 70s. There's a buddy of mine, Paul, who's in the oil business. He actually trades the physical commodity. And he's been telling me, for the last month, he said, oil's going to 150 or 160 a barrel. He said, it's simply a supply and demand thing. He said, you can expect to see gas at $10 a gallon. So let's just say, as a consumer, let's not make it real technical. If I'm a consumer and the cost of heating are going up and the cost of fuel in my car is going up, how can I offset that in my portfolio? Have some energy exposure, right?
Yeah.
Have oil stocks, have the commodities, have an ETF, have some exposure here, natural gas, because the dynamics, just the supply and the demand dynamics of it are showing you that higher prices are coming. And you don't need to be, a PhD in economics to see it, right? We're going to have peak supply before peak demand. If demand exceeds supply, prices go up. These green mandates, while well-intentioned, are really, really restricting investment in new supply. And I'll show you a couple of charts that support that. There's also, of course, policy mistakes by government that are just contributing to this supply-demand imbalance. So prices of oil and gas, I think, are going higher. This is an interesting chart in that it shows that almost 1.5 billion, 1.5 million barrels of oil per day in refining capacity are going to be closed in the next few years.
Wow.
That's already in a market where the spreads are as wide as they've ever been, record spreads, right, in refining, and record profits. But the supply, their oil companies and investors are not investing in new supply, and that's a problem. Because Blake, as being around the markets for all the years, what takes care of high prices?
High prices. Right.
Because the new supply comes on, because it's profitable. Well, in oil and gas right now, the new supply is not coming on at the rate it used to when prices were high. And look at this. Here's a chart to show you. This is an example. This is the rig count versus the spot price of Brent crude. It used to follow pretty much perfect, right? Oil prices collapse, the number of rigs collapse. Oil prices scream up, the number of rigs goes higher. It's not happening. So those are the kind of supply demand dynamics I like to have, at my back if I'm owning something. And the other thing you've got is you've got the cycle of limitations and shortages. So those two things line up beautifully. Restricting supply does what? Leads to higher prices. Very simple. This is diesel, basically almost doubled since January.
Yeah.
Which is a problem because diesel goes into a lot of things. So here's a monthly chart on crude. I've updated it for the latest monthly bar. I know it's kind of small, but if you see that little new bar, as long as we stay above that I call it full square bar, that red bar.
Yeah.
That's very bullish. And that's in the, call it 115 area. If we hold on 115, it means odds favor. We're going to go up and hit the next level of the bar, which is the old highs, the spike highs we saw in 2008.
Yeah.
That's 150 a barrel. Natural gas, this has been a great one. We've been, all over this from the mid threes. And you always, whenever you have a winner, you never capture enough of it. That's always the lament. It's like, damn, I should have just stayed in that thing.
Yeah, of course.
So we recently hit 9. Again, supply dynamics here, very much in favor of higher prices for natural gas. This is all the charts I'm showing are monthlies because I want to kind of give you the big picture view on these things. On a shorter time frame, gas is correcting, but bigger picture, use your methods, find great places to buy at support that you're comfortable with, whatever techniques you use. And I believe you have the wind at your back for at least 2 to 3 years. Let's talk about a couple other things. We are in an inflationary bear market. I think more people are willing to admit it now than were at the beginning of the year when I said it. But you can't use the same tactics you used in a bull market to invest in a bear market. If you do, you will get wiped out. That's exactly what a bear market does. You keep trying to be the bull and you keep trying to buy the dip and hodl and all these other things, you're going to get killed and they're going to take your money away. In an inflationary bear, you got to hold higher levels of cash. You got to sell the rips into resistance, which, by the way, when I listen to your shows every morning, you've been doing that very well on the S&P.
Thank you.
You got to trade less frequently and with smaller size because the volatility is really high and it shakes you out, it stops you out. So it's not the time to be more aggressive. It's the time to be less aggressive. And you want to buy real assets, especially commodities. The goal that I have, and I learned this from an old timer 25 years ago, is if you can just hang on to your bull market gains and have cash when we hit the bear market lows, you win because you get to buy the bargains and you get to buy the generational lows. And that's the key. And so if you keep that in mind, it kind of reins you in from trying, sort of stupid things and aggressive things that worked out fine in the bull market, but they're going to get you hurt in this market.
That makes a lot of sense. And, I like to always remind people that even in these types of markets, when you've got shifts from technology into energy, there are going to be pockets of the market that do perform much better than others. And you got to find those.
Absolutely. And hopefully the themes that we're giving and that we're sharing, give you some ideas on where to look and say, okay, is the wind at the back of this group? Is the weather supporting this group? Or am I, trying to push a rock uphill? This one I want to give to people, especially people who haven't only been investing for the last 5 or 10 years. Bear markets take time. Real bear markets take time. It's not like the COVID bear market, which was done in 6 weeks, 7 weeks.
Yeah.
That's fantasy. The average length here, you could say is 25, 30 months. So we're 6 months in now, 7 months in maybe, depending on which market and what high you're looking at. So if we follow any of these other traditional bears, there's a couple years to run. And, buying the dip too soon is going to get you hurt. So you got to give the markets time. Here's another good chart that I like to post for people to look at, which is average length and average drawdown of a bear market. Again, you're looking at 2 years and 40%, 34%. I know what we've seen has been brutal, but it can get worse. And
Sure.
you have to be defensively positioned to protect yourself from, the next leg down that I think a lot of smart people think is coming. This is some timing that I have, some cycle work that I do, where I wanted to give people some general timeframes of when to expect some lows here in the bear market. I think the first major interim low, where we'll have a multi-month rally off of it, is going to be in January of 23. The penultimate low will be in August of 23, and then the low that I have, and again, it matters if the cycles follow, will be in May of 2024, which gives us roughly a 2.5-year bear market, which is within the norms of timelines that we showed in the previous part.
Yeah.
The caveat I give to this is that, look, if the Fed stops fighting inflation and starts bombing the market with liquidity, you just got to stop being negative, stop being bearish, and just buy anything, because that's ultimately what's going to drive the market. Is their liquidity is going to trump anything else, any cycles or anything else that's going on,
as it always does, right?
Absolutely. And it's taken me a lot of time and a lot of money to learn that. I paid my tuition. Because in the beginning, when you first discover cycles, you say, oh, the cycle is this, so it's going to happen. And then the Fed comes in and does something like 2007, 2008, 2009, right?
Yeah.
The market screams higher. I'm saying, wait, but the cycle doesn't agree with that. So, it's going to go down. Well, it cost me, right? And you learn these lessons. And what I'm trying to do is to share those experiences with people so they don't have to suffer the pain of those losses.
Sure.
Because it's real, man. It's real tuition. And I'm sure you've paid it too. Everybody that's been in the market has.
Yeah, I'm sure many of us have experienced that over the years.
Yeah. So here we've got, this is a monthly chart on the ES. The interesting thing to note is, if we come down and hit the trend line during that time window that I think the low is going to come in, it puts us at, ES 3000. I think that's the best case scenario. The other numbers I have are 2715 and 2300. And remember, 2300 is only 52% down off the high. So it's not like we're talking about an 80% bear market or anything like that. It's within the, probably the one standard deviation of bear market drawdowns. Yeah.
And that was a big, pre-COVID lockdowns, that 2500 level was a big number. It was a previous breakout point, multi-year breakout point. So yeah, that it would be logical.
Yep. So it's completely possible, but we play it one day at a time. Commodities, I've made the case for commodities. This is just a chart to show, what performs well in inflation going back to 1950. Real assets and commodities are at the top. So if you want to have the wind at your back, you need exposure, and there's plenty of ways to get exposure. The vehicle is not important. What's important is the timing, and then the asset class you choose, right? So getting exposure to those, I think people will be better off a few years from now. One that I like very much, but which has been frustrating everybody, both bulls and bears, is gold. I think it's a matter of when gold's going to take off, not if. This whole 2-year consolidation essentially that we've done, if you look to the left, it's basically at the previous highs, the previous all-time highs.
Yeah.
Which is, anybody that knows market structure knows that's bullish. Again, with the limitations and shortages and inflation and the breakdown in centralized institutions that the Epoch Cycle talks about, gold should be a natural sort of haven for that. So we'll see. I know it's been frustrating for everybody in it, but I think it's going to do well. Silver as well. Silver's I call it the little brother of gold, if you will. Again, we're resting on top of that thick red line, which is a very important point on geometry on the chart, and price chart. As long as we hold that, it's very bullish, and it's above that complete consolidation that we saw, that multi-year sort of sideways that we saw in silver. So again, I think it's a matter of when it's going to break out, and it has the wind at its back and can do very, very well. I heard you mention this one today on the Forex Analytics chart, copper. Copper is interesting from a couple standpoints. One, it's it's a metal and it's an inflationary hedge, and it's used. It's not a monetary metal, but more an industrial metal. The other thing is, if this green revolution is really going to happen, you know how much copper is needed to do all the batteries and the solar panels and all the green stuff that people do?
Yeah.
Tons of it. So I think copper's in a good spot. It's been doing this really funky pattern, messing up a lot of traders. But again, if you look left, we're sitting right in the area of the all-time highs, from previous up cycles. And I think if you go look at a lot of your monthly commodity charts, you'll see the same thing. They're either, if they've made highs near those all-time highs, they're basing at that high, or they're basing, above a very important multi-year consolidation that it did. And those are sort of bullish technical signals that, I combine with the cycles and with the geometry to say, that gives me pretty good odds that we're going to see higher prices over the next few years in these sort of commodities. Couple of softs for you, and then we'll be done. Coffee has really started to move the last 3-4 days. This is one where you can see we had a really nice breakout off of a base, and then we went sideways for about 6-7 months in a correction. It held on top of that previous breakout level, which is this full square here. You can see where the pullback held. They pushed it down, took some stops, and now they've reversed it up. Coffee looks like it's ready to make another run, and the run I think is going to go to the all-time highs here, all-time highs back here. So coffee looks good, and then if you're going to have some coffee, you got to have some sugar. Sugar, again, I think all the commodities we're looking at are going to make runs to new all-time highs. So sugar is one where we had a nice run off the bottom, broke out of a downtrend in the base, and we've been sort of triangulating and winding up in what I feel is this bullish triangle that should resolve higher.
Well,
so
as you're pointing, I was going to say, as you're pointing out all these commodities, you're exactly right. They are just consolidating at recent highs, and usually that's from a price action standpoint. That's a pretty bullish outlook.
Absolutely, 100%. On the other commodities I'll mention, I don't have charts for them because I don't think they're actionable yet. The grains all have been big winners, and I think they're in the early innings of their consolidation phases, while the ones we've been talking about are in the later half of them. So I don't think they're done. I think wheat could double again, believe it or not. So those, I think, once the corrections are done there, are attractive on a longer term basis. The other one, natural gas, which I showed, I really like that. I'm just bullish on the whole space because I feel like the limitations and shortages, the geometry in the charts, and then the patterns of technical analysis just lines everything up so nicely that you just got odds stacked in your favor if you get a decent entry.
Yeah. Well, you've brought a lot of great charts to the table, and that must be you. But I want to ask you a couple of questions, Ben, really quick before we wrap things up. I know you mentioned fiat currencies. They probably at some point will be non-existent, but for now, they trade against each other, whether you're trading the dollar versus the euro or the sterling versus the Argentinian peso. Whatever you're trading, it's usually one against the other. So one will perform better than the other. But I want to ask you this: so if you're looking at commodities and they tend to be bullish, should you favor commodity or countries that have commodity producing capabilities, or what's considered, let's say, a commodity currency like the Australian dollar, which is going to mirror maybe the moves in copper? Or do you maybe shy away from those because the growth prospects will be so weak that globally that maybe you don't want to hold on a commodity type of currency? Do you have any thoughts there?
My gut tells me, Blake, that if a country is rich in commodities, that they're going to have something that other people want. So, and if they want their commodities, they're going to have to buy their currency, right? So just by process of elimination, I would think there would be an inherent demand for that commodity.
Sure.
In addition to that, I think probably maybe even more important than that might be, are they self-sufficient? Because in the Epoch cycle, remember, you're going to have to depend, you're not going to be able to depend on others. You're going to have to be self-reliant. So a country like the United States, where we're blessed with more food, we can produce all the food we need, we can produce all the fuel that we need. Look at countries like that, because I feel like their currencies, because of their ability to mine their own commodities and support their own societies, should be stronger.
All right, Ben. Well, I'll tell you, this has been a fascinating presentation. I love how you put everything together. And what you're showing here is this is your Twitter handle. Is that correct?
Yeah, that's my Twitter. That's I spend a lot of time, put a lot of stuff out there, try and help people, give them heads up to what's going on.
Well, this has been eye-opening, and I'm sure for a lot of people at home. And if you're liking this content, make sure you give Ben a thumbs up if you're watching on YouTube. Comment down below. I'm sure Ben would love to field some of the questions and see what your opinions are on, not only the Epoch cycle, but the cycle that we're currently in. And also I wanted to say, maybe Ben, we might have to have another one-on-one chat between you and I over the next 4 to 6 months to see where we're at in the current cycle. What say you?
I'd love to do it, Blake. Interacting with people and sharing stuff and hearing their feedback, it stimulates me to go deeper and think about ideas I might not have thought about. So I'd love to do it.
Well, Ben, on behalf of the Trader Summit community, I want to say thank you so much for spending your valuable time with us and really, teaching us about the cycles and what goes into your thought process. And I think it is fascinating. And I hope that what you've presented today is going to help investors and traders really position themselves in the coming 6 months to a year. And I think it's going to be a big value.
Thank you, Blake. I really appreciate you having me.
All right, Ben, have a great day.
Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.